Hey everyone, Ryan Bolton here with RyanBolton.com, local mortgage expert. Today we're going to talk about how do credit scores work. Credit is a huge part of any financing that you're trying to do, whether it's on a home loan or a car loan or even employment. So knowing how a credit score actually works can make a big difference on what type of loan you get. So let's talk first about the myths of credit scores. So let's talk about some of the myths of credit scores. Let's see which ones you believe are true and which ones are false. So let's go with the first one here, job history. Do you think your job history plays into your credit score? It does not. There's nothing in the credit bureau's algorithm that factors in your job history. So no matter how long you've been on the job, now it might affect your ability to get the loan. There's underwriting guidelines that do look at your job history to determine what type of loan you're going to get. But when it comes to the actual credit score, if you've been on the job 20 years or 2 days, it has no way of factoring that into the credit score. So that's myth number one. Your job history doesn't play into your credit score. Let's go on to number two, authorized users. Authorized users. Do you think an authorized user factors into your credit score? So this is where you can add somebody to give them a credit card, maybe a son or daughter, a husband or wife or something like that, where you give them access to the credit with their own credit card and they're just authorized on your account. So do you think an authorized user helps your credit score? It does not. It used to. This used to be an old trick years and years ago where you could add your son or daughter onto your MasterCard you've had for 20 years, and all of a sudden they inherit that credit history because it shows up as a trade line. Well, the credit bureaus got wise to that practice. In fact, there was companies that were even selling trade lines. They got wise to the fact that people that were authorized users weren't actually on the account. They weren't part of the approval process. They weren't part of actually getting that initial credit card unless it becomes a negative. So if they miss a payment or the balance is really high on that card, it can actually hurt the score, but it doesn't actually help your credit score. You can't inherit someone else's credit history. So authorized users are kind of a thing in the past. They no longer count. How about the next one? Your income. Does your income factor into your credit score? So think yes or no. I'll give you a few seconds. Nope, it does not. Your debt to income ratio, your amount of debt doesn't factor in. Now, your types of loans, there is some factors of what kind of loans and how many loans that you have, but there's nothing in there that factors in your income. In fact, they don't even know what it is. Now, they can guess based on payment history and not type of debts you have, amount of mortgages you have. There's some algorithms in there to kind of figure it out, but it doesn't factor into your credit score. What you make or what your income isn't reported to the credit bureaus. They have no idea how to factor that into your credit score. So your income does not play into the credit score. Again, it can affect your approval. It can affect your ability to get the car loan or the mortgage loan or whatever you're applying for. But as far as the credit score, it does not factor into your credit score. All right, next one. Your age. Does your age factor into your credit score? Think about that one for a second. No, it does not. So it does not factor into your credit score, your age. Now, your history of your accounts can. So if you have an account that's been open for 100 years, yes, that's going to help your credit score more than one that's only been open for 6 months, but they have no way of factoring in your age as part of your credit score. So no, it does not. How about closing an account will help/hurt your credit? So I hear this one a lot. People say, well, if I close that account, it's going to hurt my credit. And it can, or it can help. So the way you factor those credit scores or the way you close the accounts makes the biggest difference. The problem that most people do is, let's say they've got 5 credit cards. They decide, okay, I'm going to get out of debt. They listen to Dave Ramsey. They do something. They're just going to get out of debt. So they have 5 credit cards. Well, 4 of them are maxed out. They slowly start paying one down as much as they can. As soon as it's 0, they close it out. Well, now all of a sudden your balance to limit ratio is spread out on the other cards that are maxed out. So the score actually can go down. Plus you lose some history with it. So the trick of that to help your credit score is to get all of them paid down to under 50 to 30% of their limit, then start to close and pay them off. And I would also go with the ones that have been open the shortest amount of time. So the short answer is it can or help. It can hurt or help your credit depending on how you actually close the account, when you close the accounts. General rule, you don't want more than 3 lines of credit. So as soon as you get more than 3 visas, that's when you can also start affecting your score a little bit because of the way the balance to limit ratio is factored. So there is a way to do it right, but most people kind of snowball it, or they have a bunch of other debt, tackle one account, close it, and sometimes the account they've had maybe the longest. And so you lose out on some of that history as well. So there is a way to do it right and wrong, and it can help or hurt your score. So this is kind of a quasi-myth kind of truth to it, but there is the right way to do it. There is also the wrong way. So let's talk about the things that factor into your credit score. Take a look at this pie chart. Number one is always going to be payment history. It's 35% of your credit score. This is how long accounts have been open, but also that there is no lates on the accounts, no major derogatories like bankruptcies and foreclosures, all those types of things. So this is where you can see somebody's credit score take a huge hit if they forgot about a little credit card that had some annual fee that gets added to the account. They don't make the payment because they didn't even know they had a balance on their account. I can't tell you how many times I've seen perfect credit other than this one little credit card that had a 30-day late because of some annual fee for $35 that people didn't realize. So that is a big factor on your credit score, is obviously going to be payment history. But number two is 30% of your credit score. And this is one people often overlook. This is your balance to limit ratio on your revolving accounts. So the credit bureaus will look at everything that's a revolving account, anything like a gas card or overdraft or a Visa, MasterCard, anything that has a limit, and then you can borrow, pay it off, borrow, and pay it off. So what they look at is anytime you're over 30% of the limit, your score starts to take effect. It starts to hit your score. The closer and closer you get to 100%, the more the score can go down. So I have people tell me all the time, well, I use my credit card, pay it off, use it, pay it off every month. The trick is they only see it once a month. Whatever's on your statement is what they've reported to the credit bureaus. So if you have, say, a $5,000 credit limit and you have it at like $4,800 and you pay it off the very day you get the statement, but slowly use it during the next 30 days, and they re-report again and you're back up to $4,800 or $4,700 or whatever it is, you always look like you're at that amount. So the trick is to pay it before the billing cycle comes out. So whatever's on your statement is actually what they report to the credit bureaus. They're always about a month behind or so, depending on when you pull your credit, and timing that can be really crucial. So a lot of times I get clients that we pull their credit, maybe they're just barely below a certain tier. If their score was up just a little bit, we would be able to get them a better loan or better interest rate or something like that. So a lot of times that's the first thing I look at is what credit cards can we pay down and just leave alone for the next 30 days to be able to get that boost to the credit score. So that is a really good tip and one of the best ways in the short term to help your credit score. Obviously, disputing lates and having good history, all that really will help. But in the short term, like a quick way to be able to boost your score, there's few things better than paying down revolving accounts. Next one we talk about is new credit. Anything that's less than 12 months old is factored into your score about 10%, because that's usually when accounts go negative, is usually very early on the loan. That's because people haven't maybe budgeted, or they went out and get a more expensive car, or they're just not used to making that payment. I mean, it seems like more lates happen in that first 12 months on a new account than afterwards. And so they'll take about a 10% factor on the new credit that you've acquired. It also factors into credit inquiries. So whenever you inquire for a loan, an actual hard credit pull, it can ding your score. I've seen 1 to about 3 points. They have changed the rules on that slightly to where you are able to pull your credit several times within the same type of credit pull. So for a car loan or a mortgage, and it still only counts as 1 inquiry. As soon as you get past a certain number, depending on which credit bureaus, then it starts to ding your credit more. But you can actually pull it up to, I think, 5 times, and within 14 days, it still only counts as 1 inquiry. They allowed for that shopping period. Once you get past that, that's when the dings are worse than they used to be. And the whole reason being is if you go out and get 3 credit inquiries, then you go out and get 3 car loans, they usually won't know for anywhere between 30 to 60 days after the inquiry. So they want to make sure that they can manage that to give time for the credit bureau to catch up with that new trade line. So that's why those little dings kind of hit your credit. I can't tell you how many times people are very nervous about pulling their credit just because they think it's going to really lower their score. And like I said, it's usually no more than 3 points, especially if you haven't pulled it in months and months or even years. I've had clients say, I don't want to pull my credit, and they haven't pulled their credit in 6 months. So it's really worth pulling it. If you're getting a mortgage loan, pull the credit, because if we can work on the balance to limit ratio, or if there's something popped up you didn't know about, having a little extra time to work on it can be crucial instead of waiting till the last second. So make sure when you're getting pre-approved, you actually pull your credit file. The next one is types of credit. This is another 10% of your credit. This is the differences between a mortgage, a revolving account, a medical collection, a student loan. All of them are factored in different ways. So if you have a lot of revolving debt or a lot of mortgages or a lot of car loans, they all kind of factor in. It's about 10% of your credit score. The last one's at 15%. This is length of credit. So how long an account's been open. That's where when paying down or paying off or closing accounts can affect your score up to 15%, depending on how those accounts are closed. So usually it's better to leave accounts that have been open the longest, to leave those open. And if you're paying off debt and trying to get out of debt and get rid of these credit cards, go with the one that is the shortest time it's been open, because that'll help keep your credit score up while you're doing some debt consolidation or while you're paying down your credit scores. So I hope this was helpful. There's a lot of fun doing these videos for everybody. If you have any comments or questions, concerns, please post them in the comment area. If you have any topic you'd like me to discuss, I'd love to do that for you. But please click and subscribe and like the video, and let me know if there's anything else, any other topic or anything else I can do for you. So have a wonderful day. If you're looking for a mortgage loan, we do loans in Utah and Nevada. I'd love the opportunity to work with you, get you pre-approved. Go to my website at ryanbolton.com, and you can apply or check my calendar and schedule a call or anything you need to do. So again, thanks for watching the channel, and look forward to talking with you next time.